Interest rates are shifting. Should you lock in a GIC or keep your cash liquid in a HISA? I ran the numbers for several different scenarios. Welcome to the ultimate showdown between guaranteed investment certificates and high-interest savings accounts in 2026. With the Bank of Canada holding firm this year, deciding where to park your hard-earned cash is more critical than ever. Today we'll break down the pros, the cons, the current top rates, and exactly which option wins based on your specific financial goals. First, let's look at the 2026 interest rate landscape. The Bank of Canada is currently widely projected to hold its target overnight rate at a stable 2.25%. The days of chasing wildly fluctuating 5% GICs from a couple of years ago are over. We've settled into a new normal where inflation is much closer to target levels. Because rates are no longer surging, your choice between locking in or staying liquid requires careful strategic planning rather than just chasing the highest headline number. Let's start with the High Interest Savings Account, or HISA. The defining feature of a HISA is total, uncompromised liquidity. You can move your money in and out whenever you need it without paying a penalty. However, HISA rates are variable, they float up or down with the Bank of Canada's moves. Currently, top competitive HISAs like EQ Bank and Neo Financial are offering standard, non-promotional rates hovering between 2.25% and 3%, depending on if you use direct deposit or hold larger balances. On the other side of the ring, we have the Guaranteed Investment Certificate, or GIC. A GIC offers exactly what the name implies, a guaranteed return. You agree to lock your money away for a set period, ranging from 30 days to 5 years, and the bank guarantees your interest rate for that entire duration. Right now, the top one-year GICs from institutions like Achieva or Wheelthone are sitting around 3.65%. The major catch: your funds are completely inaccessible until maturity unless you opt for a cashable GIC, which comes with significantly lower returns. So, how do you choose? I ran the numbers for several realistic scenarios. Scenario 1, the emergency fund. If you are parking 3 to 6 months of vital living expenses, the undisputed winner is the HISA. An emergency, by definition, is unpredictable. If your roof leaks or your car breaks down tomorrow, you cannot wait 9 months for a GIC to mature. You need that cash instantly. While a GIC might offer a slightly higher percentage, the lack of immediate liquidity makes it entirely unsuitable for your safety net. Scenario 2, saving for a house down payment in exactly 1 to 2 years. Here, the winner is the GIC. When you have a strict, non-negotiable timeline for a large purchase, capital preservation is your highest priority. You cannot risk losing money in the stock market, but you also want a better return than a HISA. Locking in a 1-year or 2-year GIC at roughly 3.65% guarantees your money will reach its target right when you need to sign the closing papers, shielding you from any potential rate cuts over the next 24 months. Scenario 3, saving for a big vacation or wedding in 3 to 6 months. The winner here is the HISA, or potentially a short-term promotional rate. GICs tend to offer their best yields on terms of 1 year or more. For anything under 6 months, the tiny fraction of extra interest you might squeeze out of a short-term GIC isn't worth the sheer hassle of locking your money up. Plus, many banks offer massive 3-month promotional HISA rates approaching 4.5% for new clients, which easily beats out short-term GICs for your travel fund. If you have a large sum of cash and find yourself paralyzed by the debate, consider the ultimate hybrid strategy, a GIC ladder. Instead of putting all your cash into one 5-year GIC, you divide it by 5. You buy a 1-year, 2-year, 3-year, 4-year, and 5-year GIC. After the first year, your 1-year GIC matures. You either use the cash or reinvest it into a new 5-year GIC. You repeat this annually. This lets you capture the higher long-term interest rates, while ensuring that 20% of your cash becomes liquid and available to you every single year. There is one crucial warning that applies to both HISAs and GICs, the taxman. Outside of a registered account, 100% of the interest you earn from both a GIC and a HISA is fully taxable at your marginal income tax rate. It is the least tax-efficient form of investment income in Canada. Whenever possible, hold your GICs or HISAs inside a tax-free savings account or a first home savings account. If you max those out, you must mentally deduct your tax bracket percentage from the headline interest rate to understand your true take-home return. The final verdict in the GIC versus HISA debate isn't about which product is fundamentally better. It's purely about your timeline. A HISA provides ultimate flexibility, making it mandatory for emergency funds and short-term floating goals. A GIC provides ultimate certainty, making it superior for known, fixed expenses arriving in 1 to 5 years. Don't fight the math. Look at your financial roadmap, determine exactly when you need the cash, and drop it into the vehicle designed for that precise job. Thank you for watching. If you liked this video, please like and subscribe.